Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right, so you've sent over these excerpts from 7 advanced real estate accounting concepts, and we're going to try to unpack them today.
Yeah, it seems like a pretty dense topic, but I think there are some real gems in there that can make a big difference for anyone involved in real estate investing, whether you're a seasoned pro or just starting out.
Okay, well, let's jump right in then. It looks like this blog post covers a lot of ground, from Section 1031 exchanges to revenue recognition to all sorts of accounting methods.
Yeah, there's definitely a lot to unpack, but I think we can break it down into manageable chunks and make it all make sense.
That sounds good to me. Okay, let's kick things off with Section 31 exchanges. The blog post talks about this as a powerful tax-saving strategy. I've heard of these exchanges, but I'll admit I'm a little fuzzy on the details.
Sure, so basically, imagine you've got a rental property that's appreciated significantly, and you're thinking about selling it.
Okay, I'm following.
But then you remember those capital gains taxes that'll eat into your profits?
Oh, God, yeah, those are never fun.
A 1031 exchange is a way to defer those taxes by swapping your property for another like-kind property.
Like kind? Does that mean I can trade my condo for, like, a fancy yacht or something?
Well, a yacht might be nice, but the IRS has different ideas.
Okay, so what exactly does like kind mean in this context?
It basically means properties that are held for productive use in a trade or business or for investment. So swapping your condo for an apartment complex or a piece of land would qualify.
Okay, so there is some flexibility there. The blog post also mentioned something called boot, though. What's that all about?
Boot. It's the tricky little wrinkle in 1031 exchanges. It refers to any non-like-kind property involved in the exchange. It could be cash you receive or maybe even personal property that's part of the deal.
So if I get some cash back as part of the exchange, that could trigger some taxable gains.
Right. The blog post used this example of ABC Real Estate. They received some cash in their exchange, and that triggered some taxable gains because of the boot.
Interesting. So even though 1031 exchanges can be great for deferring taxes, there are these little nuances like boot that you really need to be aware of.
Absolutely. And that's where working with a qualified intermediary comes in. They're like the experts in 1031 exchanges, making sure you follow all the rules and timelines.
Speaking of timelines, the blog post mentions some strict deadlines, 45 days and 180 days.
Yep. Time is of the essence with the 1031 exchanges. You have 45 days to identify a potential replacement property and 180 days to actually finalize the whole exchange.
So it's not something you can just casually browse for on the weekends. You need to be prepared to move quickly.
You got it. And that's another reason why working with a qualified intermediary is so important. They'll help you stay on track and avoid those nasty tax penalties.
Okay, that makes sense. Anything else investors should keep in mind about 1031 exchanges?
Yeah, there's this concept of mortgage relief that the blog post brought up. If you're swapping a property with a lower mortgage for one with a higher mortgage, that difference in loan amounts can actually be considered boot.
Oh, wow. I hadn't thought of that.
So it's not just about the properties themselves, it's also about the financing involved.
Right. Okay, well, this is all very helpful. Let's switch gears now and talk about non-monetary exchanges. What are those all about?
Okay, so instead of exchanging cash, imagine swapping, say, an apartment building for a piece of undeveloped land.
I see. So no money is changing hands.
Exactly. And the key concept here is fair value. It's all about determining the true worth of each property based on what a willing buyer and seller would agree on in an open market.
Fair value, is that the same as market value?
Not quite. Fair value takes into account a lot of different factors, like the condition of the property, its location, any recent comparable sales in the area, and so on.
Okay, so it's a more comprehensive assessment.
Right. But here's where it gets a bit tricky. There are a few situations where you can't just rely on fair value alone.
Oh, tell me more.
Well, the blog post mentioned three main scenarios. First, if you simply can't reliably determine the fair value, like if you're exchanging a piece of raw land with no recent comparable sales.
Yeah. It's like trying to put a price tag on a piece of art. It's worth whatever someone's willing to pay.
Yeah, exactly. The second scenario is when the exchange is part of a larger scheme to manipulate sales to external parties. Fair value might not capture the true nature of the deal in that case.
And the third scenario.
The third one is when the exchange lacks commercial substance, meaning it doesn't really change the entity's future cash flows.
So it's like rearranging the furniture in a room. It might look different, but the underlying structure is still the same.
Right. The blog post actually provided an example for figuring out the monetary and non-monetary portions of an exchange, which can get a little technical, but it's a good illustration of these concepts in action.
Well, this is definitely giving me a lot to think about. It's clear that these concepts have real-world implications for making informed decisions about real estate investments.
Absolutely. We're not just talking about abstract accounting principles here. These concepts can directly impact your bottom line as a real estate investor.
It's all about making strategic moves based on a solid understanding of the rules of the game.
Right. And that's what we're here to help you with. Now, moving on, the blog post also goes on to discuss some major real estate accounting challenges. These are things that can trick up even seasoned investors.
Sounds like we're getting into the nitty-gritty now.
Yeah, it dives into things like exchange leaseback transactions and related party transactions, which can be pretty complex.
Okay, let's break those down one by one. Starting with exchange leaseback transactions, what makes those so tricky?
It's basically the two-sided nature of these deals that creates the complexity. You're selling a property, but then leasing it right back from the new owner.
So you're kind of having your cake and eating it too.
In a way, yeah. But the question becomes, is this really a sale or more of a financing arrangement?
So it's not always clear-cut.
Not at all. The blog post talks about when it's appropriate to use sale-leaseback accounting and when you need to use different methods.
I see. And what about related party transactions? What should investors watch out for there?
Well, related party transactions are any dealings between entities or individuals that are connected in some way. Could be parent companies and subsidiaries, joint venture partners, or even family members.
Okay, so it's all about making sure those transactions are above board and there's no funny business going on.
Exactly. You want to make sure everything is at arm's length and that there's no conflict of interest. The blog post stresses the importance of understanding different scenarios like spin-offs and common control asset transfers, where things can get a bit murky.
Right, it's all about transparency and making sure everything is properly documented.
You got it. And this is an area where having a good accountant on your team is crucial.
Agreed. Okay, we've covered a lot of ground already, but let's move on to our next big topic, revenue recognition.
Revenue recognition. It sounds simple enough, but there's a lot more to it than meets the eye, especially in real estate.
I have a feeling you're right. Break it down for us.
Sure. The blog post outlines 5 key steps to make sure you're recognizing revenue correctly. First, you've got to identify your customer contracts. Then you break those down into separate performance obligations.
Okay, so you're figuring out exactly what you're promising to deliver to the customer.
Exactly. Then you got to determine the transaction price. That's how much you expect to get from the customer.
All right.
Then you allocate that price to the different performance obligations. And finally, you recognize the revenue as you fulfill those obligations.
So it's not just about getting paid, it's about tying that revenue to the specific goods or services you're providing.
Exactly. Now, a couple of things can complicate this process. The blog post mentions collectibility and continuous seller involvement.
Okay, collectibility sounds like making sure the buyer can actually pay up, right?
Yep, exactly. And then continuous seller involvement refers to situations where the seller's still involved with the property even after it's been sold.
So like maybe they're managing the property or providing some kind of ongoing service.
Exactly. These factors can really impact how and when you recognize revenue.
Interesting. So revenue recognition is definitely more complex than it seems at first glance.
Right. The blog post even mentions a shift away from the percentage of completion method for condo sales and this new continuous transfer concept, which I think we'll dive into more later.
Okay, I'm looking forward to that. Well, we've covered a lot of ground already. Let's move on to the final section for today. Real estate accounting methods. The blog post lists 6 different methods. Wow.
Yeah, it's a lot, but each method serves a specific purpose and is best suited for certain types of transactions.
Okay, so let's do a quick rundown of each method. What's the first one?
The first one is the deposit method. It's used when a sale hasn't officially happened yet, like if a buyer puts down a deposit, but there's still contingencies that need to be met.
I see. So it's a way to account for those deals that are still in progress.
Exactly. The seller wouldn't recognize any revenue until the sale is finalized.
Makes sense. What about the installment method? When would you use that?
The installment method is used when a sale has happened, but the buyer's paying in installments over time. Think of it like financing a car. You get the car, but you're still making payments for years.
Okay, so the seller would recognize revenue gradually as they receive those payments.
Right, and this method can be helpful for managing tax liability.
Interesting. What about the cost recovery method? How's that different?
The cost recovery method is the most conservative. The seller doesn't recognize any profit until they've recovered their entire investment in the property.
Wow, that's pretty cautious.
It is, but it can be a smart approach in situations where there's a higher risk of the buyer defaulting.
I see. Okay, on to the financing method. What's that one all about?
The financing method is used when the transaction is structured more like a loan secured by the property than a sale. The seller is essentially acting as the bank, financing the buyer's purchase.
So the seller is both the property owner and the lender.
Right. They continue to report the property on their books and recognize interest income as the buyer makes payments.
Interesting. And what about the profit sharing method? When would you use that one?
The profit-sharing method is typically used in joint ventures, where multiple parties pool their resources and share in the profits.
Okay, so it's a way to account for those collaborative real estate deals.
Exactly. Each party recognizes their share of the profits based on their ownership percentage in the venture.
Makes sense. And finally, we have the lease method.
The lease method is used when the transaction is structured as a lease rather than a sale. The seller continues to report the property on their books and recognizes rental income as the lessee makes payments.
Okay, so it's pretty straightforward. It's just like renting out an apartment.
Right. This method is often used in sale-leaseback transactions, where the seller sells a property and then immediately leases it back from the buyer.
I see. Well, this has been quite a whirlwind tour of real estate accounting methods. It's amazing how much variety there is and how each method serves a unique purpose.
Yeah, it's a lot to take in, but it just goes to show that there's no one-size-fits-all approach to real estate accounting.
Absolutely. It's all about choosing the method that best fits the specific transaction and the goals of the parties involved.
Right. And that's where having a knowledgeable accountant on your team can make all the difference. They can help you navigate these complexities and make sure you're making the right decisions for your real estate investments.
Agreed. Well, this has been an incredibly informative deep dive so far.
Just wait till you see what we've got in store for part 2. Welcome back. Ready to dive back into these advanced real estate accounting concepts?
Absolutely. I'm still processing everything we talked about in the last part, but I'm eager to learn more.
It's a lot to take in, but I think we're doing a good job of breaking it down.
I agree. Okay, so we left off talking about the different accounting methods used in real estate, and I'm curious to learn more about when you'd use each one.
Yeah, that's a great place to pick up. Let's start with the deposit method. Remember we talked about how it's used when a sale hasn't technically happened yet?
Yeah, like when a buyer puts down a deposit but the deal hasn't closed?
Exactly. The seller wouldn't recognize any revenue until the sale is finalized.
So it's a way to account for those in-between situations.
Right. It's all about accurately reflecting the economic reality. The sale hasn't actually happened yet, so you can't book the revenue.
Makes sense. Now, what about the installment method? When would you use that one?
The installment method's a bit more dynamic. It's used when a sale has happened, but the buyer's paying in installments over time.
Ah, so it's like financing a car.
Exactly. The seller recognizes revenue gradually as they receive those payments.
And I bet that can be helpful for tax purposes, right?
Absolutely. Spreading out the revenue recognition over time can help lower the seller's tax burden in any given year.
Smart. Okay, so we've got the deposit method and the installment method. What about the cost recovery method?
The cost recovery method is the most conservative of the bunch. The seller doesn't recognize any profit until they've recovered their entire investment in the property.
Wow, that's really playing it safe.
It is, but it can be a good strategy in certain situations, like when there's a higher risk of the buyer defaulting on the payments.
I see. So it minimizes the seller's potential losses.
Right. Now let's move on to the financing method. This one can be a bit tricky, but it's basically used when the transaction is structured more like a loan than a sale.
So the seller is kind of acting like a bank.
Exactly. They provide the financing for the buyer, and the property serves as collateral for the loan.
And the seller would continue to report the property on their books and recognize interest income, right?
You got it.
Yeah.
It's an interesting way to structure a real estate deal, especially if the buyer doesn't have the cash to purchase the property outright.
Okay, that makes sense. What about the profit-sharing method? When does that come into play?
The profit-sharing method is usually used in joint ventures, where multiple parties are involved in a real estate project.
So it's like a partnership.
Exactly. Each party contributes their resources and expertise, and they share in the profits or losses based on their ownership percentage.
So it's a way to account for those collaborative ventures.
Right. Now, lastly, we have the lease method.
That one seems pretty straightforward. It's used when the transaction is a lease, not a sale.
Exactly. The seller continues to own the property and recognizes rental income as the lessee makes payments.
Simple enough. I think I'm starting to get a handle on all these different methods.
That's great. It's a lot to digest, but understanding these methods is crucial for making informed decisions about your real estate investments.
I agree. Now, the blog post also went into some detail about specific challenges that can come up with revenue recognition. You mentioned collectability and continuous seller involvement earlier. Can you elaborate on those?
Sure. Collectability is all about assessing the likelihood that the seller will actually receive the payment they're expecting from the buyer. It's basically a risk assessment.
So you're making sure the buyer can actually pay up.
Exactly. If there's any doubt about that, it can impact when and how the seller recognizes the revenue.
I see. What about continuous seller involvement?
Continuous seller involvement refers to situations where the seller still plays a role in the property even after the sale.
Like if they're managing the property or providing some other service?
Right. And this can make things tricky from an accounting perspective. You have to determine whether the seller has really transferred all the risks and rewards of ownership.
So it's not always a clean break.
Not always.
Yeah.
And this is one of those areas where having a knowledgeable real estate accountant on your team is crucial. They can help you navigate those gray areas and make sure you're accounting for the transaction correctly.
Okay, that makes sense. Well, this has been an incredibly insightful discussion so far. I feel like I'm really starting to understand the nuances of real estate accounting.
Me too. And there's still more to come in the final part of our deep dive.
All right, welcome back to the show. We're ready to wrap up this deep dive into advanced real estate accounting concepts.
It's been quite a journey, lots of twists and turns, but I think we've uncovered some valuable insights along the way.
I agree. Now, before we wrap up completely, I want to circle back to something we touched on earlier. Revenue recognition. Specifically, those challenges that can pop up, like collectability and continuous seller involvement.
Yeah, those can definitely make things tricky. Let's start with collectability. Basically, it's about making sure the buyer can actually pay up.
Seems pretty straightforward, but I'm sure there's more to it.
Well, you got to assess the likelihood that you, as the seller, will actually receive the money you're expecting.
So it's like checking their credit score before giving them a loan.
Exactly. And if there's any doubt about the buyer's ability to pay, it can directly affect how and when you recognize the revenue.
You might have to wait until you're more certain about getting paid.
Right. You don't want to count your chickens before they hatch,
Yeah.
especially when you're dealing with big sums in real estate.
Definitely not. Okay, so what about continuous seller involvement? What does that mean exactly?
It means the seller is still somehow involved with the property, even after it's been sold.
So like maybe they're managing the property or providing some ongoing service.
Exactly. And depending on the nature of that involvement, it can significantly impact the accounting for the transaction.
So it's not always a clean break. The seller could still have some skin in the game, so to speak.
Right. And this is where things can get a bit tricky from an accounting standpoint. You have to figure out if the seller has truly transferred all the risks and rewards of ownership.
So it's a question of degree, right? How involved is the seller, really?
Exactly. And that's why it's so important to have a knowledgeable real estate accountant involved. They can help you analyze the situation and determine the appropriate accounting treatment.
Makes sense. It seems like there are a lot of gray areas in real estate accounting where professional judgment is really important.
Absolutely. And that's why we always emphasize the importance of seeking expert guidance. It's not just about crunching numbers, it's about understanding the underlying principles and making informed decisions that reflect the true economic substance of your transactions.
Well said. Okay, I think we've covered just about everything from this blog post. We've talked about 1031 exchanges, non-monetary exchanges, revenue recognition, all sorts of accounting methods. It's been a whirlwind tour.
It has. And even though we've covered a lot of ground, this is really just the tip of the iceberg.
I can imagine. Real estate accounting is a complex and ever-evolving field.
Absolutely. That's why it's so important to stay curious, keep learning, and reach out to those experienced professionals when you need guidance.
Couldn't agree more. Well, to all our listeners out there, thank you for joining us on this deep dive into advanced real estate accounting concepts. We hope you found it informative and helpful for your real estate journey.
And remember, as you continue to learn and grow in your real estate ventures, always keep in mind that accounting isn't just about numbers. It's about telling the story of your investments and making sure those stories have happy endings.
A perfect way to wrap things up. We'll be back next time with another fascinating deep dive into a topic that matters to you. Until then, keep exploring, keep learning, and keep building your real estate empires.